Chapter 10: Limit Management and Exposure Control. In corporate lending, effective limit management is the cornerstone of prudent risk management. A limit is a ceiling on the amount of credit exposure a bank is willing to accept to a particular borrower, group of related borrowers, industry sector, or geographic region. Limit management ensures that the bank's risk appetite is respected, regulatory requirements are met, and concentration risk is controlled. Section 1: Why limits matter. Without robust limit management, a bank can quickly accumulate dangerous concentrations of risk. If a single borrower or group defaults, the impact on the bank's capital and profitability can be severe. Limits act as guardrails, preventing excessive exposure and ensuring diversification across the loan portfolio. Regulatory authorities also impose limits on banks. For example, many jurisdictions restrict the maximum exposure to a single borrower as a percentage of the bank's capital. Exceeding these regulatory limits can result in penalties, increased capital requirements, or restrictions on the bank's operations. Section 2: Types of limits. Corporate lending involves multiple layers of limits, each serving a specific risk management purpose. Borrower-level limits cap the total exposure to a single legal entity. This includes all facilities, both funded and non-funded, across all products. Group-level limits apply to all entities within a corporate group. This is critical because related entities often share common risks. If the parent company fails, subsidiaries may also be affected. Industry sector limits control concentration risk by capping total exposure to specific industries, such as real estate, energy, or retail. This protects the bank from sector-wide downturns. Geographic limits restrict exposure to particular countries or regions, mitigating sovereign risk and economic volatility. Product-level limits cap exposure to specific types of facilities, such as trade finance or project finance, which may carry unique risks. Section 3: Committed versus utilized exposure. A fundamental concept in limit management is the distinction between committed exposure and utilized exposure. Committed exposure is the total amount the bank has agreed to lend, including undrawn facilities. Utilized exposure is the actual amount currently drawn by the borrower. For limit management purposes, banks typically monitor committed exposure, not just utilized exposure. This is because the borrower has the right to draw down the full committed amount at any time, subject to facility conditions. Monitoring only utilized exposure would underestimate the bank's true risk. Section 4: Limit breaches and exceptions. Despite careful planning, limit breaches can occur. A breach happens when the actual or committed exposure exceeds the approved limit. Breaches can result from new facility approvals, currency fluctuations, mark-to-market changes in derivative exposures, or errors in data entry. When a breach is detected, the bank must take immediate action. This may include escalating the breach to senior management, freezing new credit approvals to the affected borrower or group, requiring the borrower to reduce exposure, or seeking an exception approval to temporarily exceed the limit. The loan management system must detect limit breaches in real time and trigger automated alerts. Delayed detection can result in significant unapproved exposures accumulating before corrective action is taken. Section 5: Pre-deal limit checks. Before approving a new facility or amendment, the bank must perform a pre-deal limit check. This involves calculating the impact of the proposed transaction on all relevant limits and ensuring that no breaches will occur. The system must simulate the new exposure, including both the new facility and any existing facilities, and compare the total against all applicable limits. If a breach is detected, the system should block the approval workflow and require either a limit increase or an exception approval before proceeding. Section 6: Dynamic limit monitoring. Limit monitoring is not a one-time event. It is a continuous process. Exposures change daily due to drawdowns, repayments, interest accruals, and foreign exchange movements. The system must recalculate exposures and check limits in real time or at least on a daily basis. For banks with large corporate portfolios, this requires significant computational resources and sophisticated algorithms. The system must aggregate exposures across multiple facilities, products, currencies, and legal entities, apply the correct limit hierarchies, and generate alerts when thresholds are approached or breached. Section 7. Limit governance and approval authority. Limits are not static. They must be reviewed and adjusted periodically based on the borrower's creditworthiness, market conditions, and the bank's risk appetite. Limit increases require approval from the appropriate authority, typically the credit committee or board of directors, depending on the size of the exposure. The loan management system must maintain a complete audit trail of all limit changes, including the date of approval, the approving authority, the rationale for the change, and the effective date. This audit trail is essential for regulatory compliance and internal governance. This concludes Chapter 10, Limit Management and Exposure Control.